And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. We are approaching the end of a wild first quarter for stocks and for bond investors, and ETF flows are reflecting that turmoil. U.S. equity funds have seen outflows, very unusual. Yet international equity funds have seen big inflows. That's unusual as well. Treasury bond ETFs have seen huge inflows, but corporate bond ETFs have seen outflows. What? Let's try to make sense of all this. DJ Turney's here. He's Director and Senior Investment Portfolio Strategist for Schwab Asset Management. Nate Geraci is the President of the ETF Store. DJ, you're Schwab's voice for ETFs. I know you travel around a lot to Schwab offices around the country. What are you and Schwab telling investors nervous about the recession? What are you telling them investors nervous about banks? What are you telling investors to do right now?
So keep your eye on the long term, right? Human behavior often leads us all to overreact to short-term market moves or turmoil or things we're reading about. But if most investors really have longer time horizons, 5 years, 10 years, 20 years if you're working towards your retirement. So find a trusted advisor, get a strategic asset allocation portfolio assembled, and ETFs can do a lot to keep you diversified. And our first quarter flows are really a reminder of all the different parts of the investment portfolio ETFs can touch.
Yeah. You know, I mentioned, DJ, the big flows at the top. They are a little all over the place. We saw outflows from U.S. equity, inflows into equity international, inflows into treasuries, outflows from corporate and from high yield generally. So investors have been all over the map this quarter. Can you make sense of this? Sometimes I don't pay attention to inflows because I don't think they say much, but this one is so all over the place. It bears some commentary here, and there's the numbers here we're putting up.
Right, and the key is overall flows. We might end the first quarter with around 80 billion in ETF inflows, right? So still the tool of ETFs are still resonating with investors and advisors, and really are still the investment vehicle of choice. And then if you peel back the onion and you look at some of the subsector moves, like we talked about earlier, U.S. equities, we had a pretty rough 2022. And so human psychology, human behavior sometimes is to move away from something that hasn't been working well and look for something that has. And fixed income, now you've got yield. International equities outperformed a little bit last year, have certainly outperformed in the first quarter. By the way, kind of a welcome move. I think most U.S. investors are under-allocated towards international equities. And so rebalancing there to get some more exposure could make sense for a lot of investors. So, what we're seeing is still reassuring that ETFs are a choice for asset allocation.
Just picking up on the equity flows there, Nate. U.S. equity flows, modest outflows, but even modest is a bit unusual. Pick up on what DJ was talking about there. Is this a delayed effect from last year's poor performance? Or is it liquidity? Remember, the Federal Reserve has been raising rates and, quantitative tightening's going on, and there's theoretically less money moving into the asset management space. And remember, we talked, you and I, about this last week. Some investors are parking huge amounts of cash in money market funds toward the end of March. That's got to be telling us something. Make sense of this for us.
Yeah, so equity ETF flows are particularly interesting to me this year because you look at the S&P 500, it's up about 4% year to date, but it appears that investors have decided to take a much more cautious approach to the markets right now. I think that's a combination of investor concerns regarding the Fed potentially staying too aggressive for too long, and perhaps the economy experiencing a harder landing. Certainly the recent banking crisis is playing a role here. This just isn't an environment where investors are looking to add risk assets right now, and that's reflected in ETF flows. Now, on the international ETF side, there's certainly more investor interest there. I think that's really a combination of three things. I think there is a little bit of performance chasing going on here because broad international stocks have fairly significantly outperformed U.S. stocks since about the beginning of the fourth quarter of last year. And if you'll recall, it's been tough sledding for international stocks for the better part of a decade plus. And so I think investors are looking at that performance and perhaps reallocating there. I also think there is a subset of investors betting on a Fed pivot at some point, which that could pressure the US dollar. A weaker dollar does tend to be a tailwind for international stocks. And then some investors view valuations as much more attractive overseas. So I think it's a combination of those three things. And then I'll just point out one real bright spot for ETFs this past quarter, which you were alluding to, has been on the fixed income side of the equation. About $40 billion has gone into U.S. Treasury ETFs alone this year. And if you look at that, it's really across the curve. But specifically, if you look at shorter term U.S. Treasury ETFs, nearly $20 billion has gone into those. And I think the mentality there is very simple, which is given the uncertainty around the Fed and the economy, and then you toss in a regional banking crisis, I think investors are content to hide out in treasuries, scoop up 4 or 5% yield, and wait until things look a little better.
But Nate, even with the big inflows into Treasury ETFs, overall flows this year are positive, but they're a lot smaller than they've been in recent years. I have 70 billion. This is your number in inflows so far. I mean, this time last year we had $200 billion. We had 3 times as much in inflows here. So even with these huge inflows into treasuries and international, this is a subpar quarter. I'm just curious about this. We haven't seen this in a while, you know.
Yeah, and I think that, again, just speaks to the apprehension on the part of investors. They're not willing to take risk right now. And I'll give you a good example of this. If you look at an ETF, say, like the Technology Select Sector Spider ETF, XLK, or you look at the ARK Innovation ETF, ticker ARKK, to me, those offer a real window into investor psyche right now because both of those are up around 20% this year. XLK has $2 billion in outflows. ARKK has slight outflows, about $100 million. That's a clear indication of overall investor sentiment right now. Investors simply aren't buying this up move, particularly when you start peeling back the layers and you look at a sector like tech.
Yeah. DJ, I want to go back to the bond fund things because this split in flows for bond funds is really quite startling. So you've got a number of these. So your short-term Treasury ETF had inflows, big inflows. I think it was $3 billion, and everybody else's short-term Treasury funds had big inflows. But elsewhere, we had generally outflows from corporate bond funds and high-yield funds. So this was sort of one of the more jarring months for bond ETFs.
Yeah, I agree. And what Nate was just saying makes perfect sense, and we can apply the same logic to the fixed income market. So it's overall a little aversion to risk, right? So high yield bond funds, outflows, even investment grade corporate bonds, a little bit of outflows, and on the corollary, inflows into treasuries, right? So it's a seeking safety move, which is not surprising. And then the yields of front-end treasuries are pretty compelling. Right? There was a point in time in the first quarter where you could get almost 5% yields for front-end treasuries. Now with the rally that's come down, it's closer to 4.25, 4 3/8. But that's still pretty. That's a fair amount of income for a front-end treasury ETF. And even in the equity flows, if we look, as Nate was saying, you know, the valuations in international might be a little bit more reassuring. And if you look at where the flows did flow in the first quarter into equity ETFs, if you look at the top 10 U.S. equity ETF inflows, quality, value, and dividend income was the common theme for the top 10 ETFs.
Yeah, and DJ, just comment, I think Nate made a very interesting point about tech funds having outflows after getting it. We had big inflows for 2 years. I mean, really big inflows. And now we've had outflows for tech funds in the first quarter, even as Nate mentioned, Kathy Wood's ARK fund. So it's curious to me to see outflows when actually tech stocks have been relative outperformance this year. Usually they go along with the trend, right? But they're not this year. Yeah. And that's curious to me.
I think there's comfort in investing in companies that are making money now. So there's a term, short duration equities, right? Companies that are making money, lower PE, price to earnings ratios. And that's really what we're seeing with the flows. And if you look at the funds, like Nate mentioned, the growth funds, you know, really those are more a bet on the future. on future cash flows years down the road. And by the way, when rates go up, you tend to discount those future cash flows. So there are some fundamental reasons why they might not be seeing the inflows. And then again, the human emotion of seeking certainty in an uncertain world and an uncertain time right now.
Yeah, you know, it's curious to me, Nate, among ETFs, it's not a high yield or corporate bond fund that seems to have the highest quarter to date outflows. ESG funds are seeing some very noticeable outflows. iShares has a ESG fund, ESGU, which has had nearly $6 billion in outflows. Has ESG lost its luster? Is it due to politics, or the underlying stocks are poor performers? What's going on here?
I think it's a confluence of several factors, and we saw this trend start to develop last year where, first of all, if you look at the performance of ESG funds in general over the past year or two, they've underperformed the broader benchmarks. And investors are seeing that underperformance and questioning whether this is something that they want to allocate to in a portfolio. I think certainly ESG has become much more politicized over the past year. And I'll tell you, just from an advisor's perspective, we don't want politics in our portfolios. We always have to assume that 50% of our clients are on one side of the aisle, 50% on the other. And certainly there's a spectrum there. But ESG has become viewed as much more politicized. And I don't think that's something that advisors want to allocate to. And I think investors are questioning. And then the third point is simply that I think ESG as a whole is under a microscope where investors are wondering, you know, what does this really do? Does me investing in an ESG approach have any meaningful difference on society at large? Because that's one of the ways that ESG has been marketed. Now, certainly we can have a conversation around whether or not screening for certain ESG factors can reduce the risk of a portfolio. I think there's certainly a debate to be had there. But I think just stepping back and you look at the way ESG has been marketed as a whole, I think investors aren't buying it. And we're seeing that in the flows.
Yeah, I've had some intellectual differences with ESG funds for a long time. But they're intellectual differences. And remember, E, S, and G can be very different subjects. So it's a really tough subject to sort of mash these three things together and create performance metrics around it. And then you throw in the fact that some of this has become very politicized. It makes it even more difficult. But DJ, I want to go back to your point at the top of the hour because, you know, I'm an old Jack Bogle disciple. Charles Schwab disciple too. Stay put, have a plan, know what your risk tolerance is. Exactly what you were saying at the top of the hour. Are Schwab investors, for the most part, fairly sticky with their assets? I sense Schwab investors are really more long-term people, and yet when you get this kind of thing in the last month, it makes a lot of people nervous. And of course, we know people make mistakes when they get nervous and start trying to trade actively. What do you think Schwab investors are well educated about your message, the long-term investing message?
Well, the flows are somewhat reassuring, right? Overall, the industry flows into ETFs are still positive. And if you look at Schwab ETFs specifically, and granted we're a microcosm, we've got 29 ETFs, but 22 of them did see inflows. And so we still are seeing, by and large, net inflows in investing through our vehicles, which can be a reflection of our investors more specifically. So I'd like to think that the advisors out there that are highly engaged right now in the market time, it's both, by the way, investors calling them and them reaching out to investors, hoping that they're keeping people on an even keel and eyes on the horizon and longer term, because getting caught up in market turmoil and trying to make changes due to near-term events generally doesn't work out that well, right? Nobody can predict the market timing and the market upswings. And so just staying long-term invested with a good asset allocation plan, you know, generally gives the best prospects for long-term outperformance.
Yeah. And, you know, people like you and me, Nate, that follow these flows, you know, microscopically, sometimes make a big deal out of this. Now, and the quarter flows are a little bit unusual on a historical basis. But when you look at it, $3 billion in outflows for equities is a drop in the bucket. We're talking about a $6 trillion, $7 trillion business here. So while the numbers are a little unusual in terms of their direction, the actual dollar numbers, even Treasury ETFs, $39 billion in inflows, is not an enormous number compared to the actual dollar value that's invested in the overall ETF business. I always want to point this out to people who want to sort of make a big deal about these fund flow things. So I think DJ is right. The actual numbers themselves are a little unusual in their direction, but not titanic in terms of the amount of money that's involved. Do you agree, or do you have a different perspective?
Yeah, it's a great point, and I would echo what DJ said. Look, we take a longer-term approach to investing, and just think back over the past 3 or 4 years. We had a once-in-a-generation pandemic. We then had a meme stock and crypto bubble. We had Russia invading Ukraine last year. This year, we have a banking crisis. There's always going to be something that comes along, and I think you have to stay focused on the longer term. ETF flows in the short term, I think, can be indicative, as we were talking about earlier, of investor sentiment. But longer term, we know in the ETF space the trend is up, and it's up at a fairly significant trajectory.
Yeah, and I think that's very significant. The fact that we have, in a quarter with absolutely wild moves, still positive flows into equity ETFs and bond ETFs. And while it's much lower than before, that's quite remarkable still. Gentlemen, thank you very much. That does it for this week's ETF Edge. My thanks to DJ and Nate. We've asked Nate to stick around and give us a little more insight into where ETFs are going this year for the ETF Edge podcast. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.